The month of May was the worst showing in a year for stocks. Stocks closed out their worst month in more than a year by sliding again on more unsettling news about Europe. The Dow Jones Industrials dropped 122 points Friday after Fitch Ratings gave Spain the second downgrade of its credit rating in a month. The rating agency's action was another reminder to traders of the long-term economic problems still facing several European countries, and perhaps the rest of the continent and the global economy as well. Everything is connected. May was difficult as persistent and intensifying worries about Europe's debt problems sent the Dow down 7.9%, and the broader Standard & Poor's 500 index down 8.2%. Both indexes had their worst monthly performance since February 2009, the month before stocks began the recovery from 12-year lows. The Dow had its biggest May drop since 1962. And yes, when they stand up, they fall back down again. This time, it's different. The last trading day of May fit the pattern of the rest of the month. Stocks alternately plunged and recovered, then dropped late in the day as investors facing a 3-day holiday weekend decided to play it safe and sell. More volatility. Fitch cut Spain's rating by 1 notch, saying the country's plan to cut its budget will likely slow economic growth. Mounting debt forced Spain, among other European countries, to recently impose austerity measures to try and contain its rising deficit. The rating agency also cited the recent bailout of a regional bank by Spain's central bank as a sign that the country's economic recovery will lag. Earlier this month, Standard & Poor's lowered its rating of Spain's debt. Greece and Portugal have also suffered downgrades. People are worried about Europe, and we're seeing a knee-jerk reaction, particularly ahead of a long weekend, said Joe Hyder, a principal at Raymond in Cleveland. He said traders won't want to be holding some investments since U.S. markets are closed on Monday, while European ones are open. More chaos and confusion. And panic. Hyder noted that the new rating, just one short of Fitch's highest, is still good. It was more the timing of the cut before the holiday weekend than the actual downgrade itself that surprised investors, he said. The market's reaction was an example of how quick investors have been to sell during May. Although the day didn't see the huge swing stocks had earlier this month, including the May 6th plunge that took the Dow to a loss of 1,000 points in less than 30 minutes, there was still plenty of emotion. Yes, and welcome to the machine. Greece, the most troubled European country, has received a bailout, and several companies are cutting their budgets to make it easier for them to pay their bills. But investors fear that the region's debt problems can't be contained. In other words, it's getting out of control. They're also worried that austerity measures will stifle economic growth and that Europe's slowdown will become the world's slowdown because, yes, all the world's economies are connected now. And there are fundamental problems with all the world's economies. Major problems. Markets drop this month has given it what's called a correction. That's considered a drop of 10% or more from a recent high. S&P 500, the index most watched by market pros, ended May down 10.5% from its high for the year, reached April 23rd. The Dow is down 9.5% from its 2010 high, reached April 26th. On Friday, the Dow fell 122.36, or 1.2%. The S&P 500 index fell 13.65, or 1.2%, while the Nasdaq Composite Index dropped 20.64, or 0.9%. About 2 stocks fell for every one that rose on the New York Stock Exchange, where volume came to 1.45 billion shares. The anxiety about Europe sent interest rates tumbling in May. Investors were buying U.S. government debt because of its reputation for safety. The yield on the 10-year Treasury note rose to around 3.70% at the beginning of the month, but then fell to a 2010 low of 3.07% this week. However, corporate borrowing rates rose, and particularly junk bond rates, as investors grew uneasy about company bonds. The problems in Europe led investors to ignore continuing signs of improvement in the U.S. economy during May. Investors' fear is that forced cutbacks in government spending in Europe in the coming months will curb the continent's economic growth and in turn, yes, the U.S. so-called recovery. Next week will bring a series of economic reports that will test the market even further. If there are any signs that the U.S. economy is being affected by news of Europe's problems, for example, if consumers seem to be spending less, investors are likely to start selling again. The report Friday showed that the U.S. recovery might be slowing down a bit. The Commerce Department said consumer spending was flat in April compared with the previous month. It was the first time in 7 months that spending had not risen in a month, indicating that consumers are still somewhat tentative about the health of the economy. This month was damaging to the psychology of investors, so consumption may taper in the near term. We're not far enough removed from the 2009 drop. People are saying, not again. And yes, everything is connected, and everything is numbered. These are more signs of the end times, transition days. Everything that must change rapidly or quickly. Ezekiel chapter 13, verse 19. And will ye pollute me among my people for handfuls of barley and for pieces of bread, to slay the souls that should not die, and to save the souls alive that should not live, by your lying to my people that hear your lies. 20. Wherefore, thus saith the Lord God Almighty, Behold, I am against your pillows, wherewith you there hunt the souls to make them fly. And I will tear them from your arms, and will let the souls go, even the souls that you hunt to make them fly. And there are many different types of signs happening daily all around the world.